Welcome! Today we're diving into whether your emergency fund is actually too big and costing you money. We'll explore how to size your cash cushion correctly, why high-yield savings accounts behave the way they do, and when surplus cash should shift into better-yielding, tax-efficient options, all while keeping liquidity and safety front and center. Let's get started. Before we begin, please note that this video is for educational purposes only and does not constitute financial, legal, or tax advice. Speak with a qualified professional about your specific situation. Interest rates and yields change often and vary by provider. Tax treatment depends on your jurisdiction and personal tax profile. FDIC insurance applies to eligible bank deposits. Brokerage products, including Treasury ETFs and money market funds, are not FDIC insured, though brokerage accounts may have SIPC protection for custody, which does not protect against market losses. Here's our roadmap. First, we'll clarify the purpose of an emergency fund. Next, we'll discuss right sizing, why 3 to 6 months is the standard, and why holding six-figure cash can be counterproductive. Then we'll examine HYSA rate dynamics and the difference between fixed and variable arrangements. After that, we'll separate trivial rate chasing from meaningful improvements. We'll cover tax-advantaged cash alternatives and finish with a step-by-step action plan and a couple of quizzes. An emergency fund is essential for short-term shocks. However, if the fund is too large, you can sacrifice long-term growth. The goal is to balance safety and liquidity with yield, so you're not giving up thousands in potential returns over time. Getting that balance right is key to building sustainable wealth. Start by defining your essential monthly expenses: housing, utilities, food, transportation, insurance, and minimum debt payments. Then multiply by 3 to 6 to get your emergency fund target. For example, if essential expenses are $3,000 per month, your EF should be between $9,000 and $18,000. If you're holding far more, like large six-figure sums, consider separating the true EF from surplus cash. Keep the EF in a liquid, high-yield savings account. Move surplus funds into long-term investments or tax-efficient cash vehicles, depending on your time horizon and risk tolerance. Maintain the EF in a separate account from day-to-day spending to avoid accidental drawdowns. This flowchart outlines the sequence. First, determine essential monthly expenses and compute 3 to 6 months as the emergency fund target. If the EF isn't fully funded, prioritize building it in a high-yield savings account. If it is fully funded, assess whether there is surplus cash. If surplus exists, consider where it belongs based on time horizon. Short-term needs can stay in HYSA. Slightly longer dated but still conservative needs can use short-term Treasury ETFs or government money market funds for potential state tax advantages. And genuinely long-term money can be invested in a diversified portfolio to pursue higher expected returns. High-yield savings accounts are attractive because they are liquid and generally safe. Variable rate accounts at top online banks usually adjust their yields promptly when the Federal Reserve changes policy rates. In contrast, fixed-rate arrangements may require manual renewals and can lag behind the current rate environment. If you are locked into a low fixed rate while better variable options exist, you may be leaving money on the table. The key is to favor options that adjust efficiently while preserving the liquidity you need for emergencies. On the left, fixed-rate products lock in a specific rate for a term, but they often require manual renewal and can lag behind when market rates rise. They can be helpful if you need certainty and accept potential opportunity cost. On the right, variable rate online HYSAs typically adjust rates quickly when the Federal Reserve moves. They generally require less maintenance and can be advantageous in rising rate environments. The better choice depends on your priorities: certainty versus responsiveness and convenience. Let's quantify the trade-off. A move from 3.2% to 3.7% on $100,000 equals about $500 more per year before tax. That's a meaningful increase for minimal effort if it only requires opening or switching to a top-tier online savings account. However, constantly moving funds for tiny increments, like 5 or 10 basis points, can waste time and create operational friction. Many experts warn against this kind of rate chasing unless the difference is material. For example, a meaningful percentage point or two, depending on your situation. This table illustrates how state tax can affect your net yield. If a high-yield savings account pays 4% and is subject to a 5% state tax on interest, the effective yield drops to approximately 3.8%. In contrast, Many short-term Treasury ETFs are exempt from state income tax on interest, leaving the full 4% at the state level. Government money market funds often invest primarily in U.S. government securities, which can make a large portion of the income state tax-exempt, though it varies by fund and year. These numbers are illustrative. Always check current yields and your own tax circumstances. If you prefer to keep large cash reserves outside of traditional savings accounts, consider short-term Treasury ETFs or government money market funds. Their yields are often competitive, and interest may be exempt from state and local taxes, improving your after-tax results depending on your state. These vehicles seek to preserve liquidity. Treasury ETFs can experience small price movements, but short duration keeps volatility modest. Always review fund documents, expense ratios, holdings, and tax characteristics. Quiz time. The question is, what is a reasonable maximum size for a typical emergency fund? The options are 1. 12 to 24 months of total income. 2. Up to 6 months of essential expenses. 3. 10 to 12 months of total spending. 4. Whatever your checking account can hold. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is up to 6 months of essential expenses. This range balances liquidity for emergencies with the opportunity to invest surplus funds for long-term growth. Here's a practical plan. First, audit your essential expenses. Second, calculate a 3 to 6 month target for your emergency fund. Third, choose the right accounts, a top-tier online HYSA for the EF, and consider Treasury ETFs or government money market funds for surplus cash that still needs liquidity. Fourth, transfer funds and keep the EF separate from surplus, ideally with automated savings. Fifth, review quarterly to ensure your rates remain competitive and avoid wasting time on tiny incremental rate differences. This timeline breaks the process into 1 week. Day 1 is for auditing expenses. Day 2 is for opening or confirming a top online HYSA and, if appropriate, a brokerage account for a Treasury ETF or government money market fund. Days 3 and 4 involve transferring the emergency fund and surplus to their respective destinations. Day 5 is for setting alerts and automations. Day 7 marks the beginning of ongoing quarterly reviews to ensure your setup remains competitive. Watch for these traps. An oversized emergency fund leads to significant opportunity cost over time. Inflation can reduce the real value of your cash. Mixing your emergency fund with daily spending makes it too easy to spend it inadvertently. Neglecting taxes can lower your net yield relative to alternatives. Finally, constant rate hopping for tiny improvements often costs more time and hassle than it's worth. To recap, set your emergency fund at 3 to 6 months of essential expenses. Use a responsive, top-tier online high-yield savings account for liquidity. Avoid wasting time on tiny rate differences and focus on meaningful improvements. Consider tax-efficient options such as short-term Treasury ETFs or government money market funds for surplus cash. Separate your emergency fund, automate contributions, and review the setup quarterly. The final takeaway is straightforward. First, size your emergency fund appropriately, generally 3 to 6 months of essential expenses. Second, avoid settling for a low-paying account out of convenience. Moving to a competitive, responsive option can significantly improve your yield. Third, if you maintain large cash balances, consider tax-advantaged vehicles like short-term Treasury ETFs or government money market funds to improve after-tax returns without losing needed liquidity. Thanks for watching. If you found this helpful, please like, share, and subscribe for more practical money insights. I'd love to hear your emergency fund target and how you're optimizing your yield. Share your thoughts in the comments.